as we're speaking right now, gold and silver are both way up, and silver is outpacing gold, which is normally how the late stages of precious metals bull markets go. You begin with gold because that's the big name in the sector. When you're nervous about what currencies are going to do, you buy that gold, the gold goes up, and then you realize that for the 1 ounce of gold, you can get a whole pile of silver, and so people start buying silver, and that being a very thinly traded market starts to go straight up.
And I think there was another one a bit later, which wasn't so much speculative, but both of them took silver to around $50, and so this time we've gone to $50. But if we adjust it for inflation, the figure I've heard quoted, and I haven't double checked myself, is we'd have to go to $180 this time around to kind of make a peak similar to the ones we've had before.
In this insightful discussion, financial analysts John Rubino and Clive Thompson break down the ongoing surge in precious metals, highlighting why silver is currently outpacing gold, a classic signal of the late stages in a bull market. According to Rubino, investors traditionally start with gold during times of currency uncertainty, using it as a safe haven. Once confidence grows, many realize that 1 ounce of gold can purchase a large quantity of silver, driving a rush into the thinner silver market. Historically, this pattern has led to dramatic silver price spikes. Rubino references past bull markets where silver reached around $50 per ounce, noting that if adjusted for inflation, comparable peaks could hit as high as $180. This illustrates the enormous upside potential still present in the sector, especially given silver's relatively small and thinly traded market compared to gold. With both metals already climbing significantly, the analysts suggest that investors closely watch silver's trajectory, as it may signal the continuation of a historic bull run. The late-stage dynamics of gold and silver could create explosive opportunities for those positioned early. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
The ones I looked at, I consider still to be very undervalued at today's silver price. I would say they're probably pricing at a silver price of $25 at the moment, not $50, or now we're $57, aren't we? So if this price holds, and I think we'll have the up and down, but I think there's a floor in the range of 45 to 55 at the moment, and then we move up into the higher levels. But let's assume that range holds. Those silver miners are going to be on extremely or very low price earnings multiples next year, when we're talking about the 2026 profits, with probably a higher price than today's price. So a doubling of the silver price from 25 to 50 doesn't mean to say the shares double. It means they do a lot more than doubling. So when I did my calculations on a number of silver miners, they all look like they got many multiples higher to go. What happens in the United States is very important to the value of gold and silver, because the less confidence people have in the US dollar, the more they're going to look for alternatives. And at the moment, there doesn't seem to be enough actions to address those deficits, which are set to be the largest ever on record this year. This year started in October. That's the fiscal year for the United States. So it's going to be at least 2 trillion of deficit, the highest ever. We've got lower rates coming from the Federal Reserve, or at least that's the opinion at the moment. Now that can change, because I know it's not 100% certain they'll lower rates in December. But the opinion at the moment is we've still got lower rates coming. Then we've got central bank buying at record levels for the last 3 years. So central banks have shown over the last 3 years buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. And there's a good reason to want more gold. And that is, we've seen a certain weaponization of the dollar. And it doesn't really matter whether you're friends or enemies with the United States. You've got to think, what if I suddenly can't get my hands on, or I can't deploy my dollars for some reason, I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months. So that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply, because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money. So it kind of implies that there were some real problems at the LBMA. But one of the funny things about if you have a high leasing rate, silver will flow in. Because people say, I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around. When the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. In one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on, but I have to accept that it is a possibility. But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion, but I'll put it down to randomness.
In this detailed market analysis, precious metals expert explains why silver miners remain significantly undervalued despite recent price gains. According to the insights shared, many silver mining stocks are still priced as if silver were at $25 per ounce, even though the current spot price has surged to $54 or $57. This gap suggests enormous upside potential, as a doubling of silver from $25 to $50 could result in mining stocks outperforming by multiples, not merely doubling in value. The discussion also highlights the broader macroeconomic factors driving silver and gold prices higher. Confidence in the US dollar is declining amid record federal deficits, while expectations of lower Federal Reserve interest rates add upward pressure. Simultaneously, central banks have been aggressively buying gold at record levels for the past 3 years, demonstrating that price is not a barrier when it comes to securing physical assets. Silver supply constraints further intensify the bullish outlook. LBMA inventories have been shrinking for years, with much of the remaining metal leased or held by institutions unlikely to sell. High leasing rates and limited physical supply create a leverage situation, pushing silver prices higher to satisfy demand. If these trends continue, silver could see even more explosive gains in the near term. Let's get into the interview.
When it comes to investing and particularly relying on the dollar. So I think people are looking for something which can't be restricted. It can't go to zero. So in that respect, gold is coming in. So then we've got the geopolitical events going on. That's not new. Geopolitical events have always been there, but obviously people think that there's a heightened tension at the moment. And that, again, is a reason why people would want to lay their hands on gold. When I say people, I'm talking about countries. And a lot of the buying has been coming from third world countries, like China, Kazakhstan, Poland, those sort of things. I don't mean to be derogatory to call them third world countries. They call them not the Western countries, shall we say? That's kind of what I meant. That's kind of where the buying is coming from. Countries which are maybe not, as of today, the greatest friends of the United States. They're not enemies either particularly, but, they're just, well, maybe some of them are, but they're just sort of saying, let's get some just in case. But I think there's also something going to continue to drive it in the next few years, probably out to 2027, 28, 29. And that's the coming digitization of currencies. We've got, starting next year, the rollout, to start with, of the digital euro, and that will go fully live the year after that. Now, I don't want to go into too many details because it's a very, very long topic, but the long and short of it is, I think you better get your gold before you've got the digital euro arrives. I think that's my, if anyone wants to know why, look at my last video, but really get your get your real gold before the digital euro arrives, because you will perhaps find that you will no longer be able to deploy your assets in the way you want, your money in the bank in the way you want to.
In this in-depth discussion, precious metals expert explains why gold continues to be a critical asset amid growing global uncertainty. With the dollar facing ongoing challenges, investors and nations alike are seeking alternatives that cannot be easily restricted or devalued. Gold, with its enduring stability, remains a go-to choice for preserving wealth and safeguarding against currency fluctuations. Geopolitical tensions further fuel demand, particularly from non-Western nations such as China, Kazakhstan, and Poland, who are strategically accumulating gold as a precautionary measure. This trend highlights that gold is not just a personal investment, but also a tool for nations to protect their economic sovereignty. Looking ahead, the rollout of digital currencies, including the digital euro starting in 2026 to 2027, introduces new considerations. Experts caution that access to liquid gold may become increasingly restricted as financial systems transition to digitized frameworks. Securing physical gold now could be crucial for individuals and institutions who want control over their assets before digital currency regulations potentially limit options. With these macro factors in mind, gold's importance as a stable, deployable asset is set to increase over the next several years, positioning it as a critical hedge against both geopolitical and monetary risks. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.